Signing a 30-year mortgage takes hours of reading and a notary, but going into debt on your phone takes a fraction of a second. Behavioral economists call this the pain of taying. It's a literal psychological discomfort we experience when we hand over our resources. A mortgage maximizes that pain. It is highly visible, rigidly enforced, heavily tracked, and tied directly to having a roof over your head. But homeowners are vulnerable. When an unexpected tax hike or roof repair drains their cash reserves, they face an immediate liquidity shock. They need a financial pressure valve, quickly. To protect their house from default, homeowners will do almost anything to bypass that immediate financial sting. They seek out borrowing that is invisible and completely frictionless. This chart shows the explosive growth of the buy now, pay later industry. It tracks the macroeconomic scale of spending, which surged from $2 billion in 2019 to $75 billion by 2023. The pay-in-4 model offers zero interest, features staggered payments, and requires no credit checks. For a stressed homeowner, it looks like a harmless budgeting tool. Because these microloans are rarely reported to traditional credit bureaus, the debt effectively does not exist on paper. The Department of Housing and Urban Development has explicitly warned that this untracked borrowing obscures a borrower's true ability to repay their mortgage. By stripping the friction out of borrowing, buy now, pay later creates an ecosystem of unmeasured phantom debt, tuned to bypass a homeowner's risk assessment entirely. To understand how this works, we have to look past the macroeconomic trends and examine the internal mechanics of the human brain. Human decision-making is heavily influenced by the framing effect, the psychological principle that presenting the exact same financial information in a different format alters how we react to it. Staring at a $1,000 upfront cost triggers hesitation, but if that identical cost is framed as $200 over 5 months, mental resistance fades. Behavioral economist Richard Thaler identified a related concept called mental accounting. We naturally sort our money into different mental buckets, assigning different levels of seriousness to rent, groceries, or fun. Buy now, pay later hacks the brain by shuffling what should be categorized as serious debt into the mental bucket of a trivial, everyday expense. Our brains also suffer from present bias, an evolutionary flaw that aggressively prioritizes immediate gratification while heavily discounting future consequences. Add to that the cashless effect. Removing physical currency from a transaction further numbs the psychological sting of losing resources. Buy now, pay later weaponizes both of these biases simultaneously. You get the physical item immediately, while the bill is digitized, divided, and delayed into the future. It actively decouples the emotional high of consumption from the psychological friction required to prevent financial ruin. Data from the J.P. Morgan Chase Institute reveals that homeowners use buy now, pay later as a direct response to financial distress. This chart tracks a homeowner's checking account balance. As their available cash declines, the reliance on microloans increases. Right at the moment of a liquidity shock, when savings hit their lowest point, phantom borrowing sharply spikes to fill the vacuum. The mental exhaustion of juggling dozens of asynchronous, invisible micropayments drains what psychologists call cognitive bandwidth. It reduces a person's capacity to manage long-term planning. This bar chart compares the financial reality of those who use buy now, pay later against those who don't. Users show drastically lower checking balances and a much higher likelihood of falling into subprime credit scores. The attempt to relieve short-term pressure actively degrades the homeowner's mind and their bank account, locking them into a state of perpetual precarity. These micro-lending services do not generate new wealth. They merely manipulate a consumer's perception of time and cost. Allowing daily spending to become frictionless and invisible slowly erodes the foundation of a borrower's most important, highly visible asset. To protect the American dream of home ownership, consumers must actively reject frictionless debt and willingly embrace the pain of paying today.